So today's video is looking at tax shelters and utilizing tax losses. So in the previous video, we looked at when a trust or a company will generate income and when those taxation events will occur. So in today's video, we're looking at losses specifically. So what does that look like for a discretionary trust? So with a discretionary trust, we know that all the income that's generated within that year must be distributed within that year. But if it incurs a loss, it gets locked up and it stays within that trust. So for example, if you had an investment property that was negatively geared, you can't distribute those losses up and benefit from that negative gearing. So that's definitely something to consider. So with these losses that get locked up within a trust, you can carry them forward into a future year where you earn income and therefore offset that income with those prior losses to hopefully reduce your overall taxable assessable income in that financial year. So with a discretionary trust, we can carry forward these losses indefinitely as long as it's limited to the family members. So ensuring that the beneficiaries or the people who are going to benefit from these distributions are effectively the same. So how's that different from a company? So with a company, losses are actually transferable between companies within the same tax consolidated group. So for example, if you had a company who made a profit and then you had a subsidiary who made a loss, you can actually apply those losses in that subsidiary against the other company and therefore actually benefit or utilize these tax losses within that current financial year. So if you didn't have any income in that year to utilize or offset, you can carry them forward indefinitely, just like a trust, but it is subject to the continuity of ownership. So similar to the trust, you can't ensuring that whoever will ultimately benefit from the income, that they are ultimately the same. And then if that fails, then the same business test. And obviously these provisions are in place to ensure that people aren't avoiding taxes by, acquiring businesses who are making losses just to absorb all their profits. So yes, this is when, engaging in a tax advice, particularly towards the end of financial year, is really important to ensure that you utilize all the losses that are available to you and ensuring that you also keep track of any prior losses. I think we see a lot of companies, a lot of businesses make losses in prior years, but don't actually disclose that in their tax return. And that's really important if we want to use them in the next future financial year. So record keeping is very important in this example. So yes, again, another bit of a technical technical video, but hopefully that did make sense. And if you have any questions, feel free to reach out to the team. Thank you.